when investors want to run a concentrated portfolio, which in my mind be something like, I don't know, 10 to 15 stocks, where they tend to get into trouble is they don't realize that when you're going to run that concentrated, there's a lot of stocks and businesses that just should be off the table completely.
If the S&P 500 was made up of the economics of the 490 stocks, this market wouldn't be up anywhere near where it's now. The reason why the market is up is because the weight of the market happens to be coinciding with the stocks that have the highest returns.
I don't know how people appreciate how big the top 7 are. So I looked at this maybe a couple of days ago. The smallest market cap of the big 7 is Tesla at $1.4 trillion.
Little baby, little baby.
And then Nvidia is like 4.5. I mean, for just give you like, you're talking about market caps that are the size of like GDPs of European countries.
It's a frequency versus magnitude, issue. It's not how many times you're right, less how many times you're wrong. It's how much money you make when you're right, less how much money you give back when you're wrong.
In a world that moves tick by tick, second by second, and inch by inch, one secret of the best investors, it remains zooming out is still a superpower. Extending your timeline, I'm told it's an edge. Compounding your compounders. The results, they're astounding. You're watching Excess Returns, and we have a brand new show for you. We're calling this the 100-Year Thinkers. I'm Matt Zeigler, and with me today, we've got Bogumil Baranowski of Talking Billions and Blue Infinitas Capital, Mr. 100 Bagger, and Woodlock House Family Capital founder Chris Mayer, and CIO of Equity Compass Investment Management, Global Leaders Portfolio PM, and author of books including The Warren Buffett Way, Robert Hagstrom. So where we're starting is with the concentrated, momentum-driven, almost unbeatable major market averages. What does it really take these days to outperform? That's our topic du jour, if you will, that we're going to sprinkle across this. Chris, I'm leading this one off with you because mega cap tech, these dominated industries, 10 stocks, the top 10 of the S&P is at like 38% of something like that. Top 10 of the NASDAQ's at like over 50%. It's a quasi-concentrated index fund scenario. Do you think, are there any 100 baggers hiding in plain sight in those top 10s? Is there a 100 bagger in the mag set?
The easy answer would be say no, because the size, right? But there's another reason I think people don't think about that would be a good reason not to fish in that top 10 or 7. But just to get a sense for the size, I don't know how people appreciate how big the top 7 are. So I looked at this maybe a couple of days ago. The smallest market cap of the big 7 is Tesla at $1.4 trillion.
Little baby, little baby.
And then Nvidia is like 4.5. I mean, for just give you like, you're talking about market caps that are the size of like GDPs of European countries. I think, Germany's GDP is 4.5 trillion. So that's like, that's Nvidia, and like France is 3. So that's, Apple or whatever. So, it's enormous, the size. So to get 100 bag from there is, it's a big number. But there's another reason why you might not. And that is that historically, if you looked at the top 10 on the S&P 500, anytime there's been some different academic research on that. Maybe it's not academic research, but I know some institutions have done it that show the top 10, when it goes over like a 20% concentration, that the top 10 underperform like 88% of the time over the next 5-year period or something like that. And there's a variety of different flavors of that type of research, but they all directionally point in that direction, which is that the very top tend not to perform that well over some rolling 5 or 10-year period after that. So that would be the reason to stay away. And you can see this historically too. Like, just for kicks, I looked at the top market caps in like the year 2000, and it's amazing. Like all those companies, except Microsoft was the only one that still did well. But some of those, it took, I think General Electric only recently got over its 2000 high. Cisco, I think, still hasn't gotten over its 2000 high. And some of these have gone nowhere for a long time. Even Microsoft had a lost decade before it really, really took off. So again, I think the way to history and research there would at least say that these top names are probably not going to be the top performers we talk about over the next 5 or 10 years.
Robert, you've shared how active managers need to maintain a concentrated portfolio that's different from the index. But Matt hinted that the top 10 stocks in the S&P 500 represent 40% or so. So are we trying to beat one concentrated strategy with another? And what are the consequences?
Bogumil, I think, there's a couple of different answers that we have to qualify here. First of all, yes, high active share investing, concentrated, low turnover investing, we know academically defensible as the way in which to outperform the market. So that's the first layer. And then the second layer is, what are you comparing against? And that being the S&P 500, if that's your benchmark, you're comparing yourself against another kind of quasi concentrated portfolio, though I would argue even at the top 10 or 40%, you've got 490 stocks that are 60% of the portfolio. So I'm not sure that is a pure concentrated, portfolio. So I do think concentrated low turnover is the way to do it. And then the question then becomes, how are you judging your progress, your performance? And that's where this all becomes problematic, because the cap weighted index, one of the things that I was, would propose that if there was no market cap weighted index and it was just all equal weighted index, we wouldn't have a topic today. Wouldn't be any controversy. But that doesn't mean that NVIDIA didn't go up. That didn't mean that Microsoft didn't go up, or Google. They all would have gone up because their earnings went up, and they all would have outperformed a greater number of the stocks in that equal weighted index because their earnings went up more, faster, greater percentage change than the other 490 stocks. So we still would have had the performance that we have today. It just wouldn't have been as controversial that our performance related to a cap weighted index looks suspicious. And I'm not so sure that it is as suspicious as most people think. I basically follow economics first. I mean, first and foremost is economics. And what became very clear over the last 3, 4, 5 years is that the economics of the mega cap stocks was outperforming the economics of the 490, in aggregate. Mm-hmm. So, I don't really get into, should I do this? I just let the economics tell me, where I should be fishing. And it's very clear that the economics of the top 10 stocks have been far superior, both in returns on capital and margins and sales and earnings, go down your KPI, but, mm-hmm. They're just outperforming the bottom 490. I mean, we took a look at the 490, or we took a look at the S&P 500 and said, if the S&P 500 was made up of the economics of the 490 stocks, this market wouldn't be up anywhere near where it's now. The reason why the market is up is because the weight of the market happens to be coinciding with the stocks that have the highest returns. The KPIs are the highest there, and that's why the market is up so much.
Chris, I want to push that logic. How do you think through it? S&P equal weight versus S&P market cap weight, or the 490 versus the 10, or
I mean, it sort of depends, what you want to measure, because if you're just trying to capture like the typical experience of an individual investor in equities, the cap weighted is probably not right, because from that individual investor point of view, all 500 stocks are on the menu and they can buy as much as any of those they want. And so if you're going to try to measure some skill, probably the equal weighted might be a better measure. Of course, I saw some research on this just this week. Somebody had written, I think his name was Carl Gavin. So I'm going to pass this on to me, but he ran just a random portfolio. It was like 10,000 different portfolios randomly from the S&P 500 last year, and compared that, to what the actual S&P did. And I think most of them wanted to beat the equal weighted index, mm-hmm. but none of them beat the cap weight, because the returns are so extreme. They, like Robert said, I mean, that's what's really driven the index. But it makes it interesting to think about, is that a fair way to evaluate managers, to compare them, to the S&P that way? Because I think of an analogy, like, let's say you're the manager of the Boston Red Sox. What if I made your goal, you have to have more wins than the New York Yankees? Is that a good goal? Probably not. You don't have any control what the New York Yankees do, right? You could win 100 games, which would be a very good season for a manager. You could still have below the New York Yankees. Or you could have 60 wins and 100 losses, and you could beat the New York Yankees if they have a really horrible season. And so that's what we're doing when we say, when we're comparing a manager to the S&P. I mean, they're just saying you're setting that kind of a benchmark. So I don't know what the answer is, what it should be, but I think as an industry, we have set ourselves a challenge in how we evaluate managers if the bar is always the S&P 500. So I would say that.
I would add and maybe remind all of us, including myself, that the 10 stocks are almost 40% today, but even at the peak of the tech bubble, they represented 25%, not 40%.
Mm-hmm.
Very different names, but that's one thing. The other thing, building on what you both said, historically, the equal weighted and market cap weighted actually are not that different. If you look over some periods of time, they are not that different. And then there are certain moments where they're completely disconnected, usually in favor, obviously, of the market cap weighted, and on the way down, which is not that surprising, in favor of the equal weighted. So I think you have to you see the menu at a restaurant, you choose whatever works for your stomach, right? Like, that's how I would look at it at the end of the day.
Well, I think we have to recognize this is just a failure of composition. Wilshire does not have this problem. The Russell does not have this problem. Miskey does not have this problem. The problem is in the S&P 500, and that's because there's 9 people on the S&P Global Committee that make the decisions about weights in the market. They could easily change the weights of the top 10 and make them less, of an impact. It's up to the S&P Committee. So, let's just take the benchmarks away. All right, let's not talk about the benchmarks right now. What would have been the best decision in the last 5 years to invest in?
Mm-hmm.
Well, the answer is, there's the top 10 stocks in the S&P 500. So that was the right economic call. You made the right economic call if you own that. I find it curious now that you're being criticized for owning the top 10 stocks in the S&P 500, not because they weren't the economic winners, and I would argue that they continue to be the economic winners, but because what you compared against has an overweighting of these 10 stocks. I would have loved to have gone against the equal weight. We would have beaten the market even greater, but, this is not a problem about that picking the right stocks in my judgment. This is a problem about, we're comparing, oh my God, every time, this happens, the role of the top 10 stocks, it is suboptimal going forward. We'll see. It's based upon the economics of what they earn. And I would make an argument that the increasing returns economics of these network economic businesses are far different than even Cisco, Intel, and Microsoft. Those weren't network economic businesses, much less the oil companies in the 60s. Every time we've had these peaks in market cap, they're brick and mortar type stocks, not network economic stocks, which is a totally different animal. So it'll be interesting to see who wins going forward, but that doesn't escape the problem that the S&P committee should probably get in there and cut the weights down. That would solve a lot of this problem.
Well, I think it depends on what you want the S&P to do. What is its purpose? I mean, they've created something that's a pretty good return, or has been a very good return vehicle for the average investor. So, but again, what do you use it for? If the thing is you want to try find some way to evaluate an active manager, then maybe the S&P 500 as it is constructed is not the best thing. So again, I think it really comes down to what you're trying to achieve with it.
To me, the powerful, there are 2 things that I'm seeing. One, the equal weighted, market cap weighted, it's the same collection of stocks when you really think about it, right? Because the 4 of us talk a lot about stock picking. It's the same 500 stocks, right?
Yeah.
But the outcomes are so different. I think it's a lesson for all of us when we build a portfolio.
Well, I would also say it's not the same all the time. I mean, every year the S&P swaps out
100%.
20 names, right? So, over a period of a decade or 2 decades, the S&P starts to look very different. And in fact, a lot of people don't even appreciate that, it wasn't until like 76 that they even included financials.
Yes.
So we always have these long-term charts of the S&P 500 as if you're comparing the same thing from year to year, but it's not the same. It's very different. And you can see it also in just looking at the top stocks, as you mentioned.
Yeah.
The top 20 and top 10 in 2000 included, General Electric, included ExxonMobil. It's totally different now.
Yeah. So if we look beyond the index construction, and Robert, you're already starting to make this point, when we look at 13F holdings and we look at some of the most respected active managers, we see a lot of those stocks. And you would argue that's still a correct part of positioning?
Yeah, well, we don't think they're, listen, Chris might relate to this. Ben Graham gave a talk in front of the Senate Banking Committee in 1955. I think it was Fulbright was the senator back then. And the Dow had gotten to record levels the first time since 1929, and everybody was freaking out. And So Fulbright asked Ben Graham, he said, what do you think of the market? And Graham said, well, the market's high. Yeah, and some stocks are high, but not all stocks are high. And there's the trick, as Chris well knows, right? And you're trying to figure out what's mispriced. And so there's some things in the market that look very, I hate to use this word bubblicious or bubble, because I think there's a bubble in bubble talk, but there's some things that are massively overpriced that I wouldn't touch, with a 10-foot pole. And some of them are in technology. I'd argue that there are also some massively overpriced stocks in consumer staples. There's no chance that Walmart is worth the same multiple as NVIDIA. If you do a reverse DCF on Walmart, they've got to earn 19% per year for 10 years to justify their current price, which is never going to happen. So Walmart's overvalued, Costco's overvalued, and there's some tech stocks that are overvalued. But there are some tech stocks that look to be very reasonably priced and very attractive investments. And a few of those are also in the top 10. So I'm not going to sell those that are in the top 10, no matter the controversy. And oh my God, they're 40% of the S&P, Robert. You're setting yourself up for disaster. I follow economics. That's all I do. Just tell me what the economics are, and that's what I want to invest in.
Can we pull on that thread? Because I think it's a very profound truth. So when we look at the index, it's not that somebody decided the weights, but it's also the economic success of the businesses behind those stocks, right? That put them in that place. It's not the 5 people or 9 people that decided that NVIDIA has to be 7% of the index. NVIDIA got there through its own success and obviously the valuations, everything else, but it wasn't given to NVIDIA or the other ones, the position that they have. They earned it. And I think that's what...
No, but I think also you have to say, what we see is the track record. That's the record of success to this point. It doesn't say anything about the future at all.
Yes.
Market could be completely wrong, and it has been completely wrong. That's the point of looking at the top 10 in years past. You, over a long period of time, you can see the dangers. Nobody stays on top very long. It's a very competitive marketplace. So somebody's going to figure that out. Now there's always exceptions, like Microsoft, again, we mentioned, has been very good even, from 2000, although you did have to go through a decade where you were not going anywhere. But it's very, very difficult to stay on top. I mean, and Robert knows that. I mean, you go back even to like 1980, if we looked at the top 10, it would be even more astoundingly different than it did in 2000. So again, over long periods of time, next few years, who knows? It's probably they got enough momentum, what they may continue for a while. And like Robert kind of hinted at, I mean, this is much different kind of companies than were in 2000. Now we have this huge AI spending, but they're doing it out of the cash flow. So it could go on for a long time.
But, point well taken, Chris. So the other thing that there's certainly a Darwinian nature to all these, the better economic performers go to the top of the class. But I'm always remembering, and Chris is pointing this out, which is the biggest problem for buy and hold investors. And Warren talks about this is, he admits the mistakes, the biggest mistake that he has made, and the one that has cost him the most money, is trying to figure out the favorable long-term prospects of company. Like, is it going to continue to do what it's going to continue to do? Is it going to continue to earn high returns on capital? Is it going to continue to maintain the margins? And when he looked back at his failures, it was, he thought it was going to do better than it did, and it ended up doing not as good. And that's how he lost money. So Chris is exactly right. Today, we've made the right decision. The question is, over the next 5 years, what's going to be the right decision? And that's what makes markets.
Yeah, absolutely. And the nature of those DCFs too, you really appreciate that for the value of these companies, most of that value is in 5 years out. The next 5 years is not really worth very much. You can kind of play around with whatever you want. But it's that, terminal value, you use the technical term, or that's really drives it, especially for the kind of companies that we like, which are the ones that are economic successes. They usually carry multiples because the market knows they create enormous value. They have high returns on capital, lots of reinvestment opportunities. And so, the market gives them a good market cap as opposed to something that trades at 10 times earnings. There's a reason. It's because it's probably low return. There's not a lot of reinvestment opportunities, probably more existential risk. And so there's less of that terminal value you're relying on. You're getting more of your value in the next, say, 5, 6, 7 years or whatever. So it's the challenge of investing in a nutshell.
Let's talk about personal concentration and personal position building and position sizing. How big, like Chris, apply this to yourself now. How big will you let a position get? How big will you let one run to?
Well, I mean, I think this is, comes down, I don't know if there's a right answer to this. It comes down to kind of personal preference of what you can do. And, I have a hedge fund that my documents allow a stock to get as high as 25%. And I would never put 1/4 of the fund's assets into that. And my kind of top would be somewhere around 8% or so. And then if it appreciates to get to that, that's a nice high class problem to have, and I would be happy. And individual investors could probably tolerate, pretty high levels of individual concentration. If you've worked at some business for a very long period of time and you've got a lot of stock in it, and then, that's probably pretty natural. So that's the way I would think about it. I think one thing I would say is that when investors want to run a concentrated portfolio, which in my mind would be something like, 10 to 15 stocks, where they tend to get into trouble is they don't realize that when you're going to run that concentrated, there's a lot of stocks and businesses that just should be off the table completely.
Mm-hmm.
Things that are highly levered. I would argue that if you have a 10 stock portfolio, you can't own a bank. You just can't, because they're inherently very leveraged and they can go to zero. I mean, we saw not too long ago, Silicon Valley Bank was a great, great bank for a long time and then became a zero in a matter of days. You just can't have that when you're concentrated. So you can't have leveraged securities. You can't have things that are super cyclical. You can't have, you have something even like a REIT that has to have regular access to capital markets. It would be a big risk to have in a concentrated portfolio. So it raises the bar for what you can own. And that would be, I think, an important message for people, trying to do something concentrated. Not just the amount, but the types of things that you own.
Chris, I had not heard it framed like that before. I think it's brilliant. I mean, if you're going to do this, there's a template of companies that would qualify in a concentrated portfolio and others that should be excluded, not because they're not mispriced or whatever, but, when you right size the bets, if you're going to do a 10% bet, there's certain qualifications that should be required to make a 10% bet. I've never heard it framed like that way before, Chris. Well done.
Thank you. Yeah. If we had like 30 or 50 stocks, sure, you have a room for, a basket of 5 or 6 banks or whatever, but it's different when you're running concentrated.
I want to tie it back to a couple of things that came up so far. Ronald Reagan had this saying about government policies. If it moves, tax it. If it keeps moving, regulate it. If it stops moving, subsidize it. And you'll see why I bring it up. When you look at the top 10 from S&P 500 from 20 years ago, Chris, you just talked about banks. 3 major banks that received government bailouts soon after that. You have GE that keeps on restructuring. And then you even have Intel that's getting propped up by federal help right now. So, and these are the top 10 from 20 years ago. Should we expect something similar from the Magnificent Seven? Is it different today? Are they all waiting for government help at some point? I mean, what's the context? It looks like, to me, it's unimaginable that the winners from 20 years ago found themselves in a position that they were.
You want that one, Chris?
Well, I'll throw out an idea, Robert, and then you can see what you say. I would say almost the opposite. When it comes to the Big Seven today, I think it's more government hurting them, and forcing them to break up or forcing them to sell off something or split. I mean, you you remember when AT&T had to be broken up and we had the Seven Sisters and all. Yeah, all that, right? So, I mean, could these things get so large that the government said, okay, we can't have, Facebook also own, I don't know, whatever, Instagram, whatever it is. It just forces these businesses to split or something like that. I could see that. I mean, because every once in a while you see these headlines already where there are these enormous fines being handed down from some EU competitive body. It's like it's not much for any of these companies to pay relative to the amount of cash they have and so forth. But in just absolute dollars, it's an enormous amount of money. Yeah. So I almost look at the government as almost targeting them in a different way, not so much helping them, but almost breaking them apart.
Yeah, I think when the government has gotten involved in the past, let's not include the last year or two, but particularly in the great financial crisis, because if that company or companies were to fail, it would have been an existential threat to the entire economy.
Right.
So the Federal Reserve or the government has to step in for the sake of the economy. So then you have to reframe your question, I think, Matt Bogumil, is that would the top 7 qualify as something that, if they didn't succeed, would be an existential threat to the country? That introduces Intel. I mean, Intel should have probably gone away. But I think under the current administration, they perceive that would it be in our national security interest to probably have a foundry here in the United States, even though they can't make GPUs. Maybe they're getting there. it is obviously the government's idea or decision at this point that Intel needs to stay, despite the fact without that help, it probably would have gone away. So they view it from a national security threat, which is different than an economic threat. But that's just kind of the world that we're living in. So NVIDIA went down and they were the only producer of GPUs for the Western world. I don't think the government would let NVIDIA go down. And the Chinese have their GPUs with us not having our GPUs. So it's how it's framed as an existential threat, either to national security or to the economic well-being of the country.
I keep thinking of Professor Demidoran and that whole idea of the age of an investor. And it's like, is Intel just on Social Security and Medicare now? Is that what had happened? The ARPA mailer just came in, they took the ownership stake.
Yeah.
You've seen a lot of these cycles. So Robert, for you specifically, are the companies today that much different than companies 10, 20, 30, 40 years ago? How do you think about that difference, and what's different and what's the same?
Well, let's go back 20 years because I think 25 years, because I think, where everybody is spending a lot of time or telling stories of metaphors that today is 1999. I managed money in 1999. I had a growth portfolio. I worked with Bill Miller. He had a value portfolio. And, Bill, he was manager of the decade and did phenomenally well. And he, thinking about concentration, Chris, I don't know if you remember, Lake Mason Value Trust at one time had 24% of the portfolio in Dell Computer. And that was that had gone up 8,000% in the decade of the 90s. Now, Bill didn't get 8,000%. I think he got like 6,000%. But so he made a very large bet. It's interesting though, that at the time, the market was totally different in 2000 than it is today. I think the 10-year
Totally different
back then was, 7%. The economy was slowing. Interest rates were higher. The multiple of the market, I think, if I remembered at that time, was 32 times forward. GE was probably 40 times, but here's the kicker.
Yeah, Coke was 50, remember?
Coke was 50, yeah.
Microsoft, Intel, all those were the four horsemen, right? Cisco was 100 times forward earnings. Okay, that's a totally different world than when you look at today. NVIDIA is 40 times, Amazon is 37 times, Meta and Google are 20 some odd times. The 10 years, 4%. The forward market's 23 times. So when you do these comparative systems analysis and you compare periods, we have a tendency to latch on to that which is in common, which is a lot of tech stocks went up in 2000, and the biggest tech stocks were what caused the market to go down. Well, it's the differences when you do comparative systems analysis that you spend most of your time on. And the differences today versus in 2000 are dramatic. And so simply to say today's like 1999, it's like Professor Demidoran, Demodrian, said, investing is building a bridge between stories and numbers. We're really good at storytelling. People do storytelling because it's easy. That's how we communicate. It's very lazy also, because unless you do the numbers with the stories, you don't have a credible argument in my mind. So people are talking stories today, but they haven't done the work. They haven't done the numbers. And if you do the numbers, I think your argument that today is 1999 doesn't carry water.
Well, speaking of Bill Miller, one of my favorite little anecdotes, he had beaten the market for however many years in a row. I think he wrote about this in 2005, if I remember. So the streak was probably 10 or 11 at that time. I think it ended at 13. But he said in his letter that if you looked at it, by month, it happened to be that was the only period where they beat the market, for all 10
100%.
Yeah.
He said if the market would have ended on November 30th, it was a 15-year streak that ended, I think, 2007.
Yeah.
And he said the market ended on 9/30. I think he only would have beaten the market, 10 out of 15 years, but it wouldn't have been 15 consecutive. So he did say in his writing, I got lucky because the calendar worked out in my favor.
Yeah. Yeah. But I remember that time also because one thing that was very different about that market than now too is that in the late 90s and up to 2000, you had the huge multiples on the tech stocks, but it created this vacuum otherwise. Like you could buy oil-related stocks for hardly anything. REITs were trading for, very cheap prices. So there was anything that smacked of old economy. Even Warren Buffett's Berkshire Hathaway was kind of thrown in the penalty box for a while because I think for years it went nowhere. And the market was up like 200% and S&P and Berkshire went nowhere for years. So that was where it's different. Where we are now, there isn't that kind of divide. I mean, anything that's quality even is still getting a pretty decent multiple. compared to that.
Well, I think, I'd like to hear Chris, talk. When we look at the bottom 493, we're very unimpressed. I mean, there's always exceptions, right? But if you look at the economics of the bottom 493, they're growing single digits, right? Earnings are basically single digits. Revenues are single digits. Margins are mediocre.
Yes.
And so you go, okay, what's the big deal? I mean,
well, it's interesting. There's a bias too in the construction of the S&P that we haven't mentioned, which is that, there are liquidity constraints. So one of the things I love to invest in companies where insiders own a lot of stock.
Yeah.
And so those by nature tend to get excluded from the S&P because they don't meet them. Because if you have 40% of the stock held by insiders, it's not going to meet liquidity requirements to be in the S&P. But if you look at those collection of companies that could be in the S&P but aren't because of that, their economics are higher than the 490 as well.
Point very, very well put, taking in obviously liquidity in that index with so many trillions of dollars, that they have in management, they've got to have liquidity. But it begs the question, if there were no AI stocks, if AI had not been invented, right? And there was no AI, what would have been the return of the S&P 500 for the last 3 years?
It would have been a lot lower. I know just for this year, you probably saw as well, I think it was a JP Morgan research where they said 75% of the S&P 500's return this year is from AI related stocks.
Yeah. But
and it probably is that high for the last 3. I mean,
I was keeping the piece of paper, but you're right about that. But I think AI stocks, the top 10, have contributed almost 80% of the earnings of the S&P.
Absolutely. Yeah.
In my mind, the market got it right. The market said, this is where the earnings are, so these stocks should go up. But the anomaly is, and I'm so glad to have Chris here, is that in the old days, that was the Russell 2000. In the old days, the Russell 2000 was the cradle of innovation, the cradle of earnings growth, the cradle of revenue growth, and all that. It's so ironic today that the Russell 2000 no longer is it's the nursery of that anymore because, venture capital and private equity keep these guys private for so long. When they come out, they're 50 billion. They never show up in the Russell 2000. So the irony is that the innovation and the earnings growth that we used to, depend upon the Russell 2000 for is actually at the top part of the S&P 500. I mean, that's just mind blowing.
Yeah, there's a lot fewer companies listed now in the U.S. than there were in 2000. I think we've probably lost 30 or 40%. It's a high number.
Yeah.
And just like Robert said, and the Russell 2000 used to be kind of the, you'd see all these companies come out and they'd be young and, growing, but now those companies are largely private. And when they go public, they're enormous compared to.
Well, before David Swenson got onto the private equity gig in the late 1990s, they had to go public because that was the only place they could get money.
Yeah,
that's right.
Back to the liquidity argument.
You had some private investors with you. You had to keep your lights on. You didn't have that much revenue. You're building a company. The only way that you could stay in business was to go public. And so they went public in the Russell 2000. Today, they can stay private for a long. Private equity give you as much money as you want to stay private. They almost want you to stay private. So when you do come public, you're going to come public at a mammoth number. That's going to be a huge payoff for these guys. So the Russell 2000, if I hear one more time, the Russell 2000 in 1980 did this, and it's going to do this again. The data's not stationary. It's not the same data today.
It's not the same index. Right.
Totally different.
Yeah. And of course, now I think one other difference is it's much easier to buy international stocks than it was back then. Like, you can have an interactive brokerage account. You can buy things on Stockholm Exchange. You can buy UK stocks. You can buy very easily. And I remember it used to be a big deal to try to get your account to be able to trade stocks in the UK, let's say, and it was expensive. So that's all that in that sense, the opportunity set is much larger. Even if you include just even, Western Europe. So,
well, then the question is, why is the U.S. market outperforming the European markets over the last 5 years? And Michael Mauboussin, I know we all know Michael, did a really good research report looking at the role of intangible investing, investing, software, model building, things like that. Intangible investing in the U.S. is almost 10 times the level of intangible investing in Europe. So when you think about, intangible investing can lead to very dramatic moats, franchises, and high returns on business if done correctly and successful. And we gravitated to, these types of companies that are dependent upon, or that actually are intangible investing companies, where Europe is still very much a brick and mortar world. And so
Yeah,
when
I
you
mean,
look
European markets are still dominated heavily by banks and energy companies and things like that, where you're going to have or telecom, where you have much lower multiples, lower growth rates. But
so,
there are still
I
some
mean,
interesting pockets of things where, like,
don't disagree.
um, yeah.
In
I always think
aggregate,
of, yeah,
in aggregate, it's just not the same horsepower that it is in U.S.
You're touching on something profound on both ends. The smaller companies, when they get listed, they're actually much larger. I mean, Facebook went public when it was, I think, $50 billion market cap. They have a lot longer runway as a private company. But at the top, these are different businesses from what I'm hearing today. They're different businesses than 20 years ago. They don't need government help. They have very high profits, very high margins. They're just successful, huge businesses. But there's also this phenomenon of winner take all kind of thing, where you have so much growth at the top, so much growth among those companies. As Robert said, that growth used to belong to much smaller companies, the Peter Lynch kind of companies, a hotel chain that has only 100 locations but could have 1,000 locations. Now, all that growth is at the very top. I want to ask you about something that a friend of ours mentioned, Daniel Paris, who is a dividend investor. You might be familiar with his writing, but he wrote a piece this summer. He called it Dr. Frankenstein's Benchmark, the S&P 500, and the Observer Paradox. You might have read it. But he said how the S&P was supposed to be a measurement tool, but it evolved into a dominant market participant that actually influences the market. Even the thing that Chris mentioned, if you're not in the S&P, you might be a totally forgotten stock. I think there's a very powerful thing there. And if you join the S&P, you get a whole different attention from the market participants. So the S&P is no longer just an observer. It became a participant. Do you have a thought about it? I think it happens a lot with different measures we use in life, where the measure disturbs the whole experience.
Yeah, I guess that started with, the ETFs and the ability to suddenly market those indexes. Because for a while they were just, something you read in the newspaper. The S&P's up, Dow's up.
Yeah.
And it took a while before they actually became viable investment vehicles that average people were pouring their 401ks in and things like that. And Vanguard had a big play in that. I mean, they're, John Bogle and his message. And so, I don't know. I mean, I guess it's true. I guess it started out more as a measurement, but it's become more of an investment vehicle now. And for better or for worse, it is kind of the opportunity cost most people think of when they think about investing, which is why active managers are often judged by beating the S&P or not.
Yeah.
Well, in the 1950s, when Warren was managing money, the index was the Dow. It wasn't S&P 500. As Chris rightly points out, that was Jack Bogle who said, let's do 500 of these, not 30. But what happened is, I guess it became, Chris no better than I maybe, is that it became institutionalized in people's thinking that this is a more appropriate benchmark or comparison than just 30 names in the Dow. And so it just came to fed on itself, and it became institutionalized. And now it's hard to imagine any large consultant as a U.S. manager doesn't have an S&P 500 as the benchmark. Even clients, used to be, they talk about the Dow. Now it's all about the S&P 500, S&P 500. It's just become ingrained in people's thinking, which would, really to kind of ask the question that the S&P 500 committee, investment committee, maybe has a larger responsibility here than maybe we, are criticizing them for. It's like, maybe you got to get this right because things are getting a little squirrely. That doesn't mean that NVIDIA is not a good investment or,
No,
but just, how it's constructed, causes some distortions in people's thinking.
I'm just thinking that and laughing to myself that it's no longer passive what we're talking about.
No, I mean, I'm thinking of like all the endowment money, and just a lot of money is tied to the S&P 500 now. So in effect, it's kind of a big bet now on the Mag 7. But
and the bigger,
let's give credit where credit's due. The S&P 500 for the last 20 years has beaten active managers. Set and match.
That's why I say they've succeeded in creating an awesome wealth generating machine. Maybe you can criticize it as a method of measuring something, but as far as an investment option goes, it's been magnificent.
So that asks the question. Well, all right. So Bill used to give us this thing. He goes, what could be the reasons why the S&P 500 beats all the other active managers? Then we'd sit there and kind of twiddle our lips going, I don't know, Bill. And he goes, well, guess what? The S&P 500 doesn't make any market calls. The S&P committee or S&P index doesn't make any interest rate calls. So think about interest rates. It doesn't think about inflation. It doesn't change sector weighting. It doesn't do all these things that active managers are all trying to figure out. So he said, well, could it be that active management is not a question that it doesn't work? Active management works. It's just a question that the way in which it's being practiced by most people doesn't work. Yeah. So active management does work. It's just the strategies used by most active managers that doesn't. And he said the S&P 500 actually has got a pretty good portfolio strategy to keep themselves out of trouble.
I think that's fair. I would also say that some institutional investors have different goals, so they don't particularly care whether they beat the S&P or not. Like I'm an advisor for an endowment, and they're not really thinking about that. But they want a certain amount of income off it, and they don't want to have to. Even if you make a rational argument that you should be fully invested and take a bit of your capital every year or whatever, they're not going to go for that. So they want a certain amount of income and don't want to touch the principal. So that's they have just different goals. They're not caring about the S&P. So there's insurance money, and there's other pockets in the institutional world that has to be managed a certain way. And they really probably should not compare themselves to the S&P because they are constraining themselves in different ways. But other than that, yeah, agree.
Well, operating inside of those constraints, as somebody who talks to a lot of pension plans, endowments, and other things too, private equity, private credit, like things that aren't volatile and promise to give you these things have really, the proliferation is just, I'm pulling the pin on this hand. Do you want to play? Do you want to play hot potato with this live action grenade first, Robert? Like
Robert, take it away.
What's up with volatility laundering?
I'm already,
all the gain, no pain.
Yeah, on record that I'm highly skeptical of private equity in pretty much all forms going forward. I think we have to realize that what David Swenson accomplished at Yale in the 1990s was extraordinary. And he figured it out, and the illiquidity premium and the opportunity set was just gold. It was just gold, and he killed it. But like any good idea, people imitate it to the point that you get to extremes and all of a sudden it's not gold anymore. And the thing that I'm struggling with is, I think if you look at let's just stay with equity and stay out of credit and real estate or whatever the case may be. But if you look at the private equity returns for the last, I'd say 10 years, but easily the last 5 years, it's been atrocious. It's horrible. Yeah. I could put it just plainly. It is very bad. Right. and they would say, well, it's the S&P 500 and the NVIDIAs and all that stuff. But the point is the economics. Let's go back to the economics. If you look at the economics of a private equity portfolio, it's nowhere near the economics of NVIDIA. It's nowhere near the economics of Microsoft or the guys that are, NVIDIA earns 100% return on capital. Show me one private business that earns 100% return on capital, right? Yeah. And so all of a sudden, private equity world, and Chris might like this, a woman from KKR was doing a show in London, and she was even saying, this is getting out of control. There are 19,000 individual private equity funds in the United States alone. And she said, you know what? There are only 15,000 McDonald's restaurants. Well, that's good. So I looked up funds. I said, all right, how many funds are there? Closed-end funds, ETFs, and mutual funds. There are only 13,000 mutual. So there are 19,000 private equity funds looking for returns today. Okay, that's a different world than the 1990s when there were probably a dozen trying to do this. So the opportunity set is nowhere near what it was, right? All right, so we have that going for us. Then the second thing is Buffett says, illiquidity, there's no illiquidity premiums left. But even if there was an illiquidity premium, you have one advantage by being in the public markets, one distinct advantage relative to private equity. You get an opportunity to buy really good businesses at 50 cents on the dollar. And you'll never get that in the private market. The private market is so competitive. Even Warren's talked about this, that I can't even compete in the private equity with Berkshire. I mean, the prices that they now compete for to close a deal make it such that I would never invest in it. So you're never going to get a big discount on your investment price in the private equity world. So I say, okay, I'm never going to get a big margin of safety. I don't have liquidity to make changes in my portfolio. And I've got some pretty mediocre returns as I look at them in aggregate. Why would anybody go there? I mean, why would you say I want to sign up for that? Then I went to a presentation. I'll leave the company out of it. And here was the opening line for the salesman trying to sell it to a retail group. As you know, it's moving into retail. And this was the opening line. How many of you are sick and tired of the volatility in the stock?
Yeah.
How many of you are sick and tired of the drawdowns? How many of you are sick and tired of your clients calling you, busting you about the stock market? How would you like for that to go away? I can give you market rate of returns, and I'll take all the volatility away. That's all they're selling right now. That's it. That's what they're selling is no volatility. As Cliff Asmus says, it's nothing more than volatility washing. Okay, so that's their game. The other thing that you have, if you drill down to it, if you look at the mutual fund companies, and sadly Vanguard's right in the middle of it, I'm sure Jack Bogle has rolled 5 times over in the grave already, is that if you look at the earnings per share of BlackRock, of Franklin Templeton, go all through them, the earnings per share is actually starting to decline, not only because active money is moving out, but the 40 Act funds are moving to ETFs, which are lower fees, right? And so their earnings economics are going there. So somebody had a brilliant idea. Well, how can we get new product with higher fees? And somebody said, that private equity stock, it's a new product and has higher fees. Why don't we try that? And now everybody's in the game. Everybody has signed up. Chris, I don't know what we're going to do, but the entire public equity marketing business world is all in on private equity. And I think it's going to end badly. I mean, I just don't see how. It's going to be an 80-20. 20% will do well. 80% are going to really struggle in my mind. Tell me I'm wrong.
No, I
can't see it.
No, I think another aspect of private equity that I find interesting is that a lot of these funds, or all these funds, have some sort of end date. It's not like they're just open-ended permanent vehicles that can own stuff forever. So, I'm thinking there's an industry I follow closely, like the insurance brokers, commercial insurance brokers. There's a lot of private equity funds that have gobbled up small commercial insurance brokers over the last decade, and now they're coming to the end of their life, and they're worth $2-3 billion, and they need exits.
Yeah.
So that creates some opportunities for the companies we like. I don't know, but that's a problem too when you're an investor, that you have this relatively short life where you got to get out of the thing.
Yeah. Well, that's why they built all these continuation funds, because they can't find anybody to buy it. So
it's very popular now. Continuation funds.
Another evidentiary point. If you can't sell what you own, it must not be worth that much, because believe me, Wall Street's looking for good ideas around the world. And if you can't sell it, and you've got to come up with more money to keep it private longer until you can find a way to make it more appetizing, it must mean that your pat hand that you own is not that attractive. Well, why would I want to be in something like that? It just doesn't make any sense to me, other than they say it's a diversifier. I don't know, maybe it is or isn't, but illiquidity and having mediocre economic returns and not being able to buy them at a discount.
And heavy fees as well.
And the fees, God, I didn't even the fees. Well, but that's the reason why, all of them are embracing private equity, because those fees will help their income. So, that's if I'm proven wrong, I'll be the first to stand up and say I'm wrong. But as I read the tea leaves or the challenges, it's a pretty big challenge. And by the point you've got sovereign wealth funds, endowments, and family office saying, I'm up to here with private equity. I can't take any more. I'm to the gills. And the next place you can go to sell money is the individual investor. The gig's up. This is the last place. This is the gig is up. If it was that good of a gig, I would guarantee you the endowments and the sovereign funds would be there. They'd be buying all they can get their hands on.
How about we zoom out, take everything we talked about, and I'm thinking, if we can't outperform the S&P 500, many of us cannot, or maybe the investors listening cannot, maybe there's another way to change our mindset about it. So, we're chasing this momentum-driven index. Maybe there's a lot of ego and FOMO in it. Maybe if we look at personal goals, something that I think Chris hinted on, maybe some risk-adjusted returns, like some of the volatility is not for us. Doesn't mean you have to go to private equity. But maybe we should redefine what we consider, good, sustainable, respectful, sufficient performance from an individual perspective, or even if you're running somebody else's money. Not trying to chase the S&P 500. Let it be.
Yeah, I think you can't start with your goal being to beat the S&P 500. that would be the end result of a very good process, is that, maybe over a long period of time, you can look back and say, hey, it beat the index anyway. But you can't start off with that.
Yeah.
Again, it's kind of like, I don't know, like a sports analogy, you can't start necessarily just saying you want to beat, everyone else or something. You have to try to create the team that's going to score the most runs, give up the fewest, that kind of thing. And you start building it that way. I think you start your portfolio the same way. You have some circle of competence, some businesses you're capable of analyzing and understanding. And so you got to work with that. You got your own temperament issues. And I mean, there's certain people that are not going to be able to own, some of these stocks, or maybe they're too volatile, or they don't understand them. And so that's a limiting factor as well, but it's okay. I totally agree with what you just said, Bogumil. I don't know how to frame it. I mean, you said it very nicely there, personal goals, and but I don't know how to put any numbers around that specifically. But it does have to be suited to your personal temperament and skill set at some level.
I think that the challenge is the time frame, because a lot of us don't want to fall behind the S&P 500 over a quarter or two, but then we want to outperform it over a decade. We're talking about 100-year thinking on this podcast, right? And I think that you can't have it both ways. And I think that's Robert's point from a lot of things that he mentioned. You have to allow that you're going to fall behind. Buffett fell behind. We all fall behind, so that we can gain a lot of ground later on. And I think a lot of managers, and I think back to Robert's point about active managers, they want to hug the benchmark so they don't fall behind, so they don't get fired from the job they have. But then they hope that doing that, they can still outperform this benchmark.
It doesn't work.
It doesn't
can't work.
Yeah.
I think, Warren was saying it best, that he doesn't rely on the stock market to tell him whether he's right or wrong. He relies on economic returns of his businesses. And we follow that to a T. I mean, in our annual report quarterlies, we have to report price. Obviously, the SEC requires it, but we show them what the revenue growth is, what the free cash flow growth is, what the return on invested capital is. We show it changing from year to year. And our point is that if these are above average economic returns, we haven't overpaid for them, we're gonna ride along with that. And when we looked at our portfolio, now 11 years old, beating our index, we're fine. 1, 3, 5, 7, 10, 11. The frequency though, by which we outperform. So we looked at, our monthly returns, our quarterly returns, and our annual returns. We only outperform the market on a monthly basis 50% of the time.
Mm-hmm.
We only outperform the market on a quarterly basis 60% of the time. And then on an annual basis, about almost 70% of the time. So it's a frequency versus magnitude, issue. It's not how many times you're right, less how many times you're wrong. It's how much money you make when you're right, less how much money you give back when you're wrong. And if you're a value-based investor, hopefully, as you make money, you're doing well, and you just don't give back as much when the market goes against you, or if you're wrong, with the market is safe. So then I looked at Henry Bessenminder. Henry Bessenminder is a great guy, and he's killing it, with his performance. And I think he said, 2.4% of the stocks, 1,500 stocks worldwide over the last 30 years were responsible for all the market value growth.
Yes.
It's a great argument, right? And so he then, in his last, it was Financial Analyst Journal, he had 50 stocks that he thought were the best global performers that had the most impact on capital appreciation, market appreciation for the last 20 years. And in that 50 stocks, 35 of them were U.S. So we took the 35 U.S. stocks, and we just did for the last 10 years, 2015 through 2024. And we said, of these 35, 17 outperformed the market, 17 underperformed the market. One was GE, but because it split up in 2024, we didn't include it. So we said, okay, let's look at the 17 outperformers. I mean, these are the best of the best of the best, right? The hit rate was 60%. On a monthly basis, they only outperform the market 50 to 60% of the time, quarterly basis. So then you say, you now know, had you put a portfolio together and said, this is going to be the best winning portfolio for the next 10 years, you'd have been wrong about half the time on a monthly basis. So so now we're back to loss aversion, because people price myopic loss aversion. So the question is, what do we do? And I think, my thing is that you've got to give them something else to look at. If the only shiny object they can see is price, an index, that's what they're going to focus on. And so what we're trying to do, and it's very hard because people are ingrained with their viewpoint, is we're saying, look, if our economics are okay and our economics are progressing at a satisfactory rate, okay, we're going to be fine. And by the way, I want to tell you, and I tell people when they sign up, we're only going to be good 50 to 60% of the time. And the other times we're going to look like a goat. I mean, Robert, you wrote a really good book, but you don't know anything to know about portfolio management. You stink. You know, it's what, not me. We own what we own. Our turnover ratio is less than 15%. And our economics are pretty good, but it's the market sloshing back and forth that causes all these problems. And so my solution would be, we've got to spend a lot more time talking about the economics of what we own and its progress and getting people to focus on that and show them the price, but say, every once in a while, these things, get out of whack, but we're going to be fine. And we've gotten some traction on that. I would tell you our best clients have always been business owners. And as I say, and I said, well, tell me about your business. And I said, what's the most important thing for you? And they go, cash. I need cash. I go, that's pretty good. That's kind of what I'm looking for too. And he goes, and what's that? Well, we want to grow it. I said, what? I want to grow it too. And he goes, and they do get capital because if they borrowed money from the bank or from, they have a cost of capital.
Yeah. And
I said, well, everything that you're doing, that's the same thing that I'm doing here. And they went, oh, really? That's what you do? And I go, yeah, that's what we do. So the business owners get it. The attorneys, the dentists, everybody else has a clue. They only see the S&P 500.
Yeah.
I think focusing on economic returns makes a lot of sense.
That's okay. All those guys are just going to sell their family-owned businesses to private equity. Further contributing to the problem. I think we've got a lot of great 100-year thinking wisdom that's coming out of this one. The Hallmark card looks something like you can't outperform the S&P 500, but you can perform pretty well with yourself and your personality if you're willing to know it. I'll send that to them, see if we can get it on a card. Robert, people want to find you on the internet these days, read some of your writing. Where should they look you up?
Well, I don't even know if there's a roberthagstrom.com, but, books are on Amazon. We're at, I'm CIO at Equity Compass. So you can go to equitycompass, all one word.com, and see the portfolio. The portfolio is transparent. You can see anything that you want. And we do have a list of our literature there, quarterly commentaries, and things like that. So everybody's welcome to take a peek, and they know how to get in touch with us via that website.
Go take a peek. Chris, same question for you. They want to bug you on the internet? Where are they from?
Yeah, I mean, very similar. Same thing. My books are on Amazon. You can find them in there. And then probably the easiest way is to go to Woodlock House. Google it, comes right up, and you can reach me through there. My books are there. Blog is there. And I don't write for it very much anymore, but there's a lot of material there still.
Go mine the material. Send your AI to do it. Boost those earnings. Bogumil, what do you think? Should we do this again in about a month? You have a good time?
100%. I loved it.
100%. That's what you heard it here first, even from Bogumil. You're watching Excess Returns. Like, subscribe, leave a comment, all the things. They're all below. Thanks for joining us, guys.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.